How do you get the best interest rate on a DSCR loan? You heard a buddy get a great rate. You call up and you can't get the rate. You're disappointed. Folks, we're going to go through details to understand what variables, knobs, and levers that you can pull to get a better rate or get a worse rate. And to have this conversation, we're going to do that with the one and only Convoy Home Loans, Dustin and Jonathan. Who's starting first, guys?
Dustin can go first.
Okay.
I should have asked earlier. My bad. Dustin, you're up.
Oh, fine. Yeah, so John and I wanted to make this video so that everybody watching could better understand kind of the small intricacies of, qualifying for a DSCR and where the differences are in rates and closing costs and all that. So I'm going to start with, this is going to be based on somebody with a 720 credit score.
Okay.
Or higher. Okay. 720 or higher. The first one is if you're doing a loan that's at 60% loan to value, you're actually going to be able to get like 1 point worth of credit back to you. Okay. So like the bank or us would give you essentially 1 percentage point
on the
of
good
the loan in lender credit to cover some of the closing costs, right? So $500,000 loan, you'll get a $5,000 credit if you're at 720 and you're doing a 60% loan to value product.
Yeah, folks, and you got to pay attention to this because really what you're going to go through here is all the different levels and why you'll really hear no mortgage broker worth of salt quote a rate because they don't know you, your asset, your deal. So the first one is, this is to my simple world, all about risk. If you're getting a loan of 60% or less, it is less risky, hence better rate. Less risk, better rate. That is number one. Jonathan, what do you got for number two?
Well, number two, I mean, the tier down, I guess, would be from like 700 to 719. Each lender, like it's again, why it's so important to kind of call and discuss where your scenario is. This is just for one specific lender that we picked out with the easiest bracket. But at 700 to 719, at the same 60% loan to value, you'll get like 75 basis points in credit, right? So, but as you go up in LTV, those credits turn into a cost. So like, for example, if you're at between 700 to 719 on your FICO and you're trying to buy something, let's say DSCR at 80% loan to value, 20% down, then you're paying actually 2.75.
Yeah.
So, like it's exactly what you said, risk wise, right? So you can't like, hey, my buddy just did one at 70% and got this rate. Why are you giving me this rate? It's because
you're not the same.
70% versus 80%. Your FICO might be different. Your buddy's probably not telling you really what his credit score is and how much he's worth, right? You guys are probably not telling each other the truth. So, yeah, so realistically speaking, that's kind of how those things break down and why credit kind of plays a big factor, even though this type of loan is based on the asset.
I like it. What do you got for number three, Dustin?
So the next and probably most common one people know is your DSCR ratio, right?
Ooh.
So
let's define that because maybe it's new for folks. What's the DSCR ratio?
So you're going to essentially just take the gross rents. Right now, if it's a refi, it's the rents that are in place. If it's a purchase, we can use the market rents. But you're going to take the gross rents divided by the PITI if you're doing a fully amortized loan, plus association dues if you're in a condo or townhome, right? Or if you're doing an interest-only loan, which is important, it's the ITI, right? Interest, taxes, and insurance plus the association. That's something we can go into in a little bit, but knowing whether or not it makes sense to go interest only so you get a better deal versus, okay, I'm still being cash flow positive, fully amortized. That's really when you want to decide which route is better to go. And we'll show you. So I'll go with the biggest one. Like the biggest line in the sand is, are you over one or are you under one in terms of, are you cash flow positive or are you not cash flow positive, right?
I like it.
So if you're over one, there's not going to be any sort of adjustments. Okay, that's just good. Like we're not going to hit or anything. You're not going to get any credit back. But if you're below one and you're even doing a 60% loan to value with a 720 credit score, you're going to pay 1.25 or 125 bips because of the fact that your DSCR ratio is below 1. Now,
Which
if you
makes
go,
sense. This is about risk, right? If you're even at 60% LTV, doesn't make it a good deal. If you're
no,
getting a 60%, fully amortized loan and you're still not cash flowing, that's risk to the lender. So it makes perfect sense.
yeah, and then I mean, you go up to 80%, you're paying nearly 2 points or 200
Oh,
bips.
wow.
But in this example, or kind of small example tying back to the interest only option, I had a client that was basically at 1.01 doing an interest only payment, and he really wanted to go fully amortized. And I was like, look, if we go fully amortized, it's going to cost you an extra 2 points. Okay. It doesn't make sense at this point because you're still allowed to pay principal even if you go interest
Yeah.
only. And
Right.
what do you know of closing interest only? Because it saved him basically $10,000 on his,
Yeah, I mean, why take that 10 grand and spread it out over the next 24 months and just chunk off $500 in principal and your money good. So makes perfect sense. Yeah. Jonathan, what do you got next?
Yeah. And then also, next I want to do like units. So like single family versus like, let's say 2 to 4 units, right? Which is the
Okay.
most common. So, there's also adjustments for units. So we have a lot of clients that call in and, they want a 4 unit with 20% down to purchase, because typically those at most lenders will be 25%, but they want 20% down, which we can do. But there is, a cost to it, right? It's not free technically, right? And let's say at the same 720 bucket, like Dustin was saying, the cost to do an 80% loan to value 4 unit is 0.625. So your cost will be just over half a point to do a 20% down, loan.
Right.
Now, this is all like added together, right? So for people that understand, like, Dustin was talking about, you get a point credit at 60%, right? And then you can then subtract out or add back whatever is on the credit wise. On this scenario, let's say it's 80% at 720, you get a 2-point hit for being at 720, but at 80% loan to value. And then on top of that, if it's a 2 to 4 unit at 20% down, then you get a 0.625 hit on top of that. So now you're looking at a total cost of 2.625, right? So that these are all added to each other.
Got it.
This is so that, the viewers and listeners understand that we don't control these things in terms of like, we can't just like, hey, here, let me pull from here.
Yeah,
make this.
we like you, so we're gonna do that. That's not how it works.
Yeah, it's the same across the board, and it's a standard, right? So lenders will adjust this as time passes, but this is kind of like how it breaks down.
Yeah.
So now you're at a
This
total of 2.625 at a cost, instead of buying it for like, hey, I just want a no cost type situation.
Yeah, this is why folks at One Rental at a Time really have to reach out to Convoy, because there are so many knobs, levers, and switches that you get to play with. And the beauty, and again, I hear it from folks, you talk to them, you ask them questions, you suggest this, you suggest that. So I appreciate all the extra work you do. I'm sure you do it for all your clients, but I know you do it for my contacts. So I appreciate that. Guys, you got one more, or do you just want to tell them how to reach out?
Yeah, I think an important one that comes up a lot is the different prepayment options, right?
Yes.
Are always going to be a topic of discussion for DSCR loans, doesn't matter who you're speaking with. But this will go across the board, whether you're at 620 FICO or 720 FICO, and whether you're at 60% loan to value or 85% loan to value. Okay, so the 3-year prepay is where you're not paying anything or you're not getting anything back. So no credit, no points you got to charge. That's just kind of the standard that we're usually going over. If you go
sorry, and when you say a 3-year prepay, that's the step down, right? 3, 2, 1.
Correct.
Okay, cool.
And I'll just take it at both sides of the spectrum. But if you go with a 5-year prepay, now you're getting 0.75 or 75 basis points back in credit.
Okay.
Right? Less risky for the bank. They can guarantee their money, etc. If you want to go no prepay, you're paying 1 point, or you're paying 100 basis points, right, to get a loan with no prepay. So essentially, no prepay is 175 basis points more expensive than a loan with 5 years worth of prepay.
Yeah. At the end of the day, folks, this is why we have loan professionals on the channel, because there's so many things that they know that even I don't after 22 years. If you want to get in the game, get pre-approved, have conversations about what is right for you, Convoy Home Loans is the way to go. Jonathan, how do they reach out?
Go to convoyhomeloans.com and let us know you came from ORAT.
Yep. Tell them you came from ORAT. You get one of these two fine gentlemen. And if you don't, no promises. Thanks, guys. Have a great week.
Thank
Thank
you.